Do you understand the difference between stocks and bonds and the percentage that you should own in your portfolio? Hi, I'm Tracy, and welcome to my series where I'm discussing common money questions in a short mini-style video. And in today's video, we're going to give you a simplified comparison between stocks and bonds, which are just two different types of investments that offer a difference in varying risk and return portfolios. So let's chat about the 5 main differences between the two. So let's start with number 1, which is ownership and debt. So when you buy a stock, you're just purchasing ownership in the company. Now this is going to make you become a shareholder. Now if the stock's value goes up, then the value of it also does. On the other hand, when you buy a bond, you're essentially just lending money to an entity, such as the government, in exchange for regular interest payments and a return of your original investment. Next is risk and return. So stocks are going to be considered riskier than bonds, but they also offer higher potential returns over the long term. So stock prices can be volatile. Now bonds are generally considered less risky than stocks because bondholders have a priority claim on the assets in case there is bankruptcy. Moving on, it's going to be income and growth. So stocks can provide income through dividends, and when the stock prices increase, so do their value. So these are often going to be favored for more long-term growth potential, where on the other hand, bonds are primarily providing income through regular interest payments. So these are often more favored for generating predictable income and preserving capital. Another big difference is going to be liquid. So stocks are generally going to be more liquid than bonds because they can be bought and sold on the stock exchanges throughout the trading day. Bonds might be less liquid than stocks, especially for more of the less actively traded bonds or those that have long maturities. And it's also important that if you're selling bonds before that maturity, you might actually incur a fee. Lastly is investment goals. So stocks are going to be more suitable for investors seeking more long-term growth, especially if you're willing to accept the risk that's involved in them. On the other hand, bonds are going to be more suitable for investors that are seeking income, capital preservation, or maybe that lower risk compared to stocks. So overall, it's just great to use a combination of both stocks and bonds to kind of balance that risk and return based on your goals. So a popular rule of thumb is just to own your age in bonds, which means if you're 30 years old, 30% of your investment portfolio should be bonds, where the other 70% is stocks. So I hope you like this quick little video. Thanks for watching. I'll see you in the comments down below. Much thanks and love, Tracy.